from the MBA, they were showing 60% of those total transactions in the week over week increase were refinances.
I think it's some near $1 trillion savings in interest rate that the government is having to pay. But a major factor is the 20 million people coming across the border and buying up housing or competing for housing here that we have.
You can specify the desired output, like the file format that you want, but it asked if I wanted it in an image or a PDF file. You can ask it to give you Excel files or, lots of different file format outputs and not just text.
Episode 58 of Market Moves with Mark and Jeff. Two uninteresting guys talking about interesting times. Jeff, it feels a little like a vibe check episode here. A lot going on in the market. You and I have been sitting, and all the listeners have been sitting in a historically bad interest rate cycle. I think conferences, I think headlines. We have, on the day that we are recording this, not the day we're releasing, but on the day we're recording this, Jerome Powell and the Fed is meeting. And in fact, the day before, they will speak and tell us what they talked about. We got a lot going on here, and there's a lot of expectations that maybe it's the beginning of the end of a bad cycle.
I mean, we can certainly hope so. Mark, I was interacting with a loan officer at just a small local community credit union who was kind of sharing this exact sentiment that you're talking about. So it's certainly not just us as appraisers in a bubble that are hoping, for some improvement in the interest rate environment. From a historical context, maybe the rates maybe aren't terrible, but from what we've seen, coming out of COVID, it sure has pumped the brakes on a lot of transactions. And I'm seeing a lot of headlines and stories around, kind of a locked up or pain in the real estate and housing market, where other segments of the economy maybe haven't been as impacted as we've seen.
Yeah, you bet. It's I've had improper optimism before in this 2.5-year stretch that we've been on here. So certainly not counting my chickens before they've hatched, and really just taking the data in as it comes. But it is notable, and I think just even at the conference that you and I last attended together, which was the appraisal conference, Val Expo, there was a palpable difference. People talking about the next cycle, one way or another, whether it's getting ready for these new forms, the UAD 3.6 appraisal forms that Fannie and Freddie are rolling out, or just getting appraiser panels set and, all those things. There is a shift in expectation, I see.
I think that's right. And we've seen it summarized in the past as, false starts, where you have this expectation and then something happens and rates move back up and it doesn't, kind of unleash this waterfall of transaction flow. At some point that is going to happen. You and I joked that it's a little tough to be talking today, not knowing exactly what the outcome is going to be, of the Fed with a decision. We had a friend of the pod, Tony, had just put out into the ethos this morning, just soliciting a 50%, not 50%, a 50 point cut, as their outcome, which, the betting markets are putting a very low probability on, but there's this kind of across the board expectation. It'll be at least 25%. By the time we release this, the news will be out and everybody will know what it is. But it's just one of those things that is interesting to realize how sensitive I think the market is to, these minor decisions, even though the Fed's decision doesn't, directly impact the mortgage rate. I think we've pretty well figured that it's priced in an expectation of a 25 bip cut today. And if it turns out to be something different, it could either be, unexpected good news or bad news for the market, depending on what the outcome is.
Jeff, I would be interested in diving into on a future episode, the idea of a constant Fed fund rate. And, I've seen this floated out a little bit from folks. As a real estate professional, my goodness, I'm sure the car folks and all that rely on these rates to do business would like the certainty that comes with all of that. Just have the rates in 5% and just keep them there. We don't need these cycles one way or another. It doesn't feel like.
Yeah, that's exactly right. And I think you make a good point. It impacts more than just real estate, from other durable goods. I just finished listening to an interview on the All In podcast where they were talking to heads of colleges, Dartmouth and Berkeley. And it's just interesting that whenever you make less expensive the cost of something, the price of that goes up. So if I have cheap borrowing costs for real estate, for a college education, for a car, one of the natural effects tends to be that the cost of that good goes up, depending on where the interest rate is. So I think it would be a very fascinating discussion to have, because I think there are implications of, constant cost of money versus fluctuating cost of money, and what the impact is when that is held down, that cost, which is what Trump is arguing for. And, it would help on the national debt and debt payment side, but are there other unintended consequences of escalating asset pricing? Just lots of implications I think are fascinating to consider.
You bet. I think we talked about the quote from Jamie Dimon, several months ago, saying that the mortgage business has been shit for 2 decades. And I think a lot of that is probably related to these interest rate swings and the things that are going on there. And I watch very closely Elon Musk and just his business case study. It's really wild what all he does one way or another. And I almost could feel him getting fed up with the car business and being so darn reliant on interest rates, and they weren't in Tesla's favor as they were getting ramped up, and said, you know what, we got to diversify away from this, is what it felt like, watching. So, they're tough on a lot of industries that rely on it for sure. But I don't know if we'd have a podcast, Jeff. So maybe, I don't know.
I think you make a good point, on that front. But yeah, I think definitely an interesting conversation to dive a little deeper into next time.
Well, on the subject of rates, here we are today, recording with rates at 6.13%. They have been hovering around 6.9%, maybe a little bit higher for the better part of a year. I have seen some stats that rates were about right here this time last year, which was pretty surprising to me. But they did quickly rise after Trump took office, and maybe surrounding uncertainty with tariffs and the other policies that were being implemented here. But boy, this is a steep drop, 6.9 down to 6.13, with no Fed fund rates drop here, Jeff. What do you see? What do you think?
Yeah, that's such a good point. And obviously there are a lot of currents that can impact, why and where the rates are. But it sure is. I'm talking with people, out there in the market representing buyers and sellers, builders, that sort of thing. There's just a lot of optimism, but I think also, acknowledgement that really is making a big difference on housing affordability for people. Everybody well, not everybody, but the vast majority of market participants assume or price affordability based on what a monthly mortgage payment is, and so it's definitely driving transactions, bringing people off of the sidelines. I'm hearing people say, man, if we get down into the 5% mortgage interest rate space, that kind of unleashes a whole nother wave of people able to come in. And I've been arguing, or at least considering for a long time, that affordability is a problem and something's going to have to give. I mean, there's really 3 legs to that stool. If interest rates come down enough, then asset pricing probably doesn't move very much. If they stayed where they were, eventually home pricing is going to have to adjust. And, we've seen minor corrections or price adjustments, but certainly not seen anything falling off a cliff, national data and, local data as I look at both. We're not seeing incomes skyrocket, which would be the other, leg to that stool that could, make housing more affordable if rates and home pricing, remained unchanged. So I think it's driving some transactions, one way or the other on, people coming off the sideline. I think there is a backlog and some pent up demand of people waiting, rates will get better, I'll buy or refi when they do. And from 6.9 to 6.13, like you said, I mean, that starts to make more sense for people.
Yeah, I was struck by I don't know. I guess it doesn't I don't think about rates this way, but I saw a quote. I would only be able to paraphrase from Matt Ishbia, the United Wholesale Mortgage CEO, that was talking about rates being lower now and the Fed funds rate and the potential of it being cut, and saying, does it make a whole heck of a lot of difference right now in affordability? Not a ton, but it really provides a marketing opportunity to all the lenders out there, to fence setters. And I think that is a lot of the case right now, that you've just got a lot of people that have found every reason not to meet the demands of life that cause home changing scenarios or circumstances. And you get a little bit of optimism. Well, now's a good time to do it because rates are way lower than they've been for a long time. Even though it's modestly lower, it is a marketing opportunity and a psychological permission to move forward.
Yeah, it really is. And I mean, you and I, through this effort, have tried to understand better how the interest rates work and what it is that actually drives mortgage rates versus the Fed's short term the Fed fund rate and that sort of thing. But the headlines, and I think a lot of people out there, the perception is, and as I talk with people, it's interesting to see that their perspective is rates haven't been cut yet, but they're going to. And so it's kind of that permission to act like you say, or this FOMO of, man, I don't want to get locked in today if the Fed's meeting next week or next month and the expectation is they're going to cut rates, even though the reality is that expectation is already priced into the current mortgage rate. It does become a marketing opportunity for a lot of the mortgage professionals, for sure.
So, here we see it said, and I mean, this is really a symptom of the pent up demand. And yeah, I mean, this is a long time now, 3-4 years that folks, I think there's a 7%, 5 or 7% natural turnover of homes around the country. It's been far lower than that over the last 2 or 3, 4 years. And that is a lot of people that need to do things or would have otherwise done something, but instead are sitting there in their current residence. So, that permission is a big deal. And, I think that leads us into the next headline, which is, it is the mortgage application, Jeff. And I mean, we're up 29% week over week. That's an enormous bump. We haven't seen anything like that in a while. It's encouraging to see. And I think it's probably servicing only the people that bought in the last couple of years, because it's nowhere near the COVID rates.
No, yeah, that's exactly right. And it's a combination of purchase transactions and refi transactions. But in this report from the MBA, they were showing 60% of those total transactions in the week over week increase were refinances. And it's interesting. I'm starting to see again something we haven't in quite a while, but it's in this refinance space. People a little bit worried about the appraisal coming in high enough to support and facilitate the transaction that they're trying to, do. They bought a couple years ago, and for whatever reason, better interest rate, which is starting to be the case, today. They want to do it, but they also have to have enough equity in the home to be able to make the transaction work. And it's just these cycles come and go, and it's been a while since I've heard anybody worried about what the value is going to be on the appraisal to facilitate their deal in a refi scenario. And part of that's because so few have been refinances at all because of the interest rates. Most of the stuff I've seen has been purchase transaction type of appraisals. But I saw one just the other day, Mark, that was just interesting. And I think it kind of makes the case or helps explain why appraisers are needed in the process. A lady had purchased a home earlier this year, as February or something, for whatever the purchase price. So I don't remember exactly what it was, but we'll say it was around $400,000. And she had in that time spent over $70,000 remodeling, fixing, replacing stuff. Home looked a lot better. It was way nicer than it was at the time. I think a lot of your automated systems, even a desktop type of an appraisal, doesn't capture the realities that can happen as homes just change over time. If they were static and never changed, the value would be a little bit easier to hone in on. But in that case, the refinance transaction was to help cover some of those costs, but there was a legitimate reason for a much different value today than what she paid, even just earlier this year. And so, as we see some of these transactions start to take place, it it justifies the appraisal on the one hand, but you can see where people are coming from and why they're wanting to take advantage of a little bit of an increase in the rate from what it was earlier this year as well.
Yeah, Jeff, you and I work with a lot of new appraisers, and it's sort of shocking that to observe. I guess, oh, you haven't been through this sort of refi cycle, and what we're trying to do for you and I, it's a little old hat, and although we haven't exercised that muscle in a long time, you kind of harken back to what it was. So it's interesting to see the newbies just seeing the different ends of the cycle, I guess, one way or another, that are coming through. Well, let's not get too far away from the rate discussion without some sort of prediction or expectation from you and I, Jeff. So the Fed is meeting today. I think they are also meeting tomorrow. My understanding is that they will speak tomorrow. What do you think is going to happen?
I like to have hot takes.
Squirm. I like this.
Yeah, I am squirming for sure. And I probably shouldn't, because I think there's a pretty clear consensus that the expectation is a 25% cut. I don't see any reason to think it's going to be different than that. I think if it was a 50%, 50, I keep saying that, a 50 basis point cut, it would, it would be a positive shock in the system, from all of our perspectives. If they chose not to cut, yet for some reason, it would have some real, I think, negative impacts in the, the market's perceptions. There are competing, data points that I know the Fed is grappling with. The job and labor jobs number and labor numbers are softening, which they're wanting to address. But we've seen a recent uptick in the CPI read. There's still concerns around inflation hovering closer to 3% than their target at 2%. And so, in my mind, it's not a sure thing, but I would predict that we do see a 25 bip cut when they announce.
What sort of probability would you put on a 50 basis point cut?
If we weren't, because of the inflation factor that they've been focused on, and in the past, Jerome has said, we're more focused on taming inflation, even if it means pain in the labor market. I would put it at maybe a 10 or 15% chance that we get a 50 bip cut. I would like to see that. I'm not voting against it, but I would put it at a pretty low probability. What about you?
Yeah, it's tough. I think I feel like if you are going to make 25 basis point rate cuts this year, I am in favor of doing them now. And I think it is forgotten on those not in this housing space. I think Americans are hurting from like an affordability perspective, and they have really sacrificed for the greater good for a really, really long time. And I think there's plenty of data to support. So we have the huge jobs negative. What I think is largest now revision in history on an annual base, 911,000 less jobs that we thought we created than before. We spent a long time talking about the Bureau of Labor Statistics on a few episodes ago. It's pretty nasty out there on a number of fronts, and a big concern. We got this hotter inflation rate. I think we have a chart on that, Jeff, if you want to pull it up. But CPI was a little hotter there. You can see that slight uptick to basically 3%. So that's not great, but about where expectation was. But this producers price index, I think this has really been the concern out there. Is that these tariffs are going to create a ton of inflation on the producers, the businesses out there. And you can see that it's really been holding steady over the last several prints, and even downticked here just a little bit. We're just not seeing a ton. And I did hear Howard Lutnick making his case. Of course, he is very pro-tariff and anti-consequence of inflation, I guess. But saying, tariffs are not inflationary because they are not. It is a one-time increase to the extent it is an increase. It isn't an ongoing increase one way or another. And by his read, the definition of inflation is like this ongoing increase that perpetual, I guess. So I don't know. I look at these numbers here and I think the job market is weak. That is one of two, and it wasn't an and sort of thing that the Fed signaled they were looking for. It was or, right? A weak job market or inflation coming down to 2%. And so I think we're close to it. So I really would like to see 50 basis points. I probably put it at maybe a 30% chance. So maybe a little more optimistic about that than you. I think honestly that interest rates will go up from today's 6.13% if it is 25% and just sort of a dovish status quo next 6 months sort of thing that I kind of expect that we'll get. So I don't know. I think that's where I am. And it's exciting that there could be a change for the moment. I think there's justification for it being more. So I'm a little disappointed that my expectation is it won't be more.
It will be really fun to see, what the outcome is. I'm just trying to read, what the Fed's perspective has been in the past, and it's been a very wait and see. We want to rely on the data. I think they are worried about inflation. I think if the CPI and PCE data was closer to the 2%, it would be pretty much a no-brainer to be at the 50. Yeah, so we'll all be watching it, with interest. In either scenario, you and I are putting it at less than a 50% likelihood that it's more than a 0.25% cut. I do have in the back of my mind to maybe a touch point as we come into October to see where our predictions are trending that we did, middle of the year. We'll see if we're any good at this prognostication thing or not. I don't know that we are. I wouldn't place any financial bets on what you and I think, even though we have gotten lucky on a couple of calls in the past.
Yeah.
But there certainly is a case for more than a 0.25% cut. I think based on what I've seen and heard, coming out of the Fed, not just in the last month or two, but over time, it's been more reactionary and trying to be data driven. Now they've missed the mark on some stuff. So I'm not certain that that their approach has always led to the right decision or outcome. And I'm sure they would have done things differently if they could go back. But yeah, it'll be interesting to see what the ultimate decision is, and even more so the justification around it and what they pencil in going forward through the end of the year, which I think is part of the case you were making, that may drive market's perception and impact rates as much as anything else if it is just a 0.25% cut.
Well, I think as we're wrapping up the conversation on rates, I think it's important to remind the viewers, if Treasury Secretary Scott Bessent hasn't done it enough, is that every quarter point is, man, I think it's some near $1 trillion savings in interest rate that the government is having to pay. And that's a big deal when you add what I think 400 billion in tariff revenue. We've talked a lot about how crushing the debt for the U.S. government is. It is crushing, and these high interest rates make it worse. And so a really positive sign for the country, I think, if there is justification from these other data points that we should lower rates, because it'll have a nice positive benefit.
It definitely will. The only thing I worry about is if we make the debt easier to service. I don't trust politicians to not just find more ways to spend more money as opposed to actually, cutting into that debt and even just the operating deficit. I don't mean to be overly cynical there, but the positive side of the high interest rates from the national debt perspective is that it puts more pressure on the government to actually make some spending cuts. But that's probably a whole different discussion and topic. But there are implications one way or the other. I think we're all better off with lower rates. I just hope that we have the discipline to be financially responsible, even if those the cuts come in and maybe come higher or longer than what we're projecting in the moment.
It's amazing too, as we're sitting here talking, that a lot of our podcast was talking about these tariffs and trade deals getting made and all of that, and how quiet it has been on that front. And we have major global players that don't have trade deals with the U.S. and still have this barbing back and forth of negotiating one way or another. So I don't know. It's amazing that we're here in middle of September and still living with that uncertainty. The bow needs to get tied on that, it seems to me.
Yeah, absolutely. I did hear or see a report that there was a consensus on with U.S. and China negotiations around TikTok, maybe leading to President Trump meeting with President Xi around some sort of a deal. I mean, I think some stability, especially between those two players would go a long way. But you're right. I mean, there are a lot of kind of solidified deals that. If they come together, could really lead to a lot of, I think, stability and a lot less concern and volatility in what we're seeing in the market.
Yeah, absolutely. Well, Jeff, I'm switching gears to housing and looking at that. I had a couple of anecdotes this week that I was surprised by. During the presidential campaign, we had Scott DiBiasio from the Appraisal Institute on, and it was talking about the Kamala presidency or a Donald presidency and the difference in policies as you could best read it, as they were campaigning one way or another. And I don't even remember which side. I mean, I guess thinking about it must have been the Republican side arguing this, but saying that the price of housing is being driven up by a lot of things, but a major factor is the 20 million people coming across the border and buying up housing or competing for housing here that we have. And I just thought to myself, well, I mean, even if there are 20 million people coming over, do they have home buying power? I don't know. It's logic would say that that's not necessarily the case to me. But so it seemed like a bit of a ridiculous argument that the Republicans were making to help housing. And I've felt that way for the last year, because it's about a year ago that we talked to Scott DiBiasio. But I just happened yesterday to be meeting with a local builder in Houston, and meeting in an area that is certainly diverse. And he is building 7-8 townhomes, whatever it is, and is going to rent them. And we were just talking about what he's doing, why he's doing it, and all that, and just said that he served all of his buyers were immigrants, and over the last year plus, they have all dried up. Nobody is willing to buy homes one way or another. So he has pivoted to renting those high-end townhomes out. I thought that was really interesting. And I think no doubt if that trend were taking place and only on a small scale, this area would be the one. It's right near the Galleria in Houston. And so it's it is an area where this sort of stuff would take place. But it was surprising to me that it is taking place at all, and to run into that anecdote.
There's, I think, a lot of value in having a finger on the pulse, kind of in the market, talking with the market participants that are seeing a change in the trend. With the immigration or immigrants coming in, if it is or was at the pace of 20 million plus. They've got to be housed somewhere. And I would guess that, your first action, coming into the United States probably isn't to buy a home, but it may be to rent something. It may be, you're going to have to be somewhere, which, at some level can put some pressure on home pricing. And it may be more in the rental and apartment space. But, does that then put pressure on those that are there to move into move up into housing at some point? I don't know, how dramatic of an impact that would be. But, your anecdote, reminds me of one that I've seen recently too, where, in the neighborhood where I live, it's just a single family neighborhood, been around for, a while, maybe an older one relative to the nature of the community here. But I've seen a trend, due to this housing affordability thing of people, whether it's extended family or even two different families kind of moving in together in the same house because of the affordability issue. And I don't have a good sense of how many may be immigrants versus not. But as I was thinking about it just the other day, people that I knew that had built or lived in homes with just their family 10 and 15 years ago, there are now multiple families or extended families, in that same house, and they've modified interiors in some cases to facilitate, an in-law apartment or something. And I think all of this speaking to the affordability issue, one way or the other, which just an interesting trend to be observing out there.
Yeah, absolutely. This is probably 2 weeks ago, Jeff, but in another example of what's going on, we've talked a lot about how prevalent new builds are in and around the country, certainly in and around Texas and Houston, where I operate. And there are pockets of 700 listings. My kids would 6, 7 thing. I don't know if you know of this trend, Jeff, but my goodness, it's all they talk about. But yeah, 700 homes for sale in MLS in certain pockets of subdivisions. But they are working to satisfy a lower end segment of the market in terms of affordability that existing homes just haven't been able to get to, with the rate setting at 7% and so on and so forth. And this agent was contemplating or making moves to kind of diversify herself out of the real estate business one way or another, at least for the time being, just talking about how hard it has been for her to compete against these new builds trying to sell existing homes, that everyone is saying buy new and get the lower rate and all of that sort of stuff. And I hadn't thought about it a ton from that perspective, but it certainly is true that there not only is the demand for existing housing already light, because there aren't very many buyers out there in general, are a lot shifting to the new builds here because they're so much cheaper comparatively.
They really are. I was just looking at some data in our market that confirms exactly, what you're talking about. DR Horton has a big project going in, and they're, we talked about this before, but they're offering better interest rates with rate buy downs. New for most buyers is more attractive than existing and lived in and not new. You've got the warranties, and you can oftentimes pick, colors or finishes that you want. But it was striking how many new homes DR was selling in this neighborhood relative to other existing homes or even like smaller scale builders in competing subdivisions or whatever. And a lot of it is the pricing power that they have with the incentives they can offer. We've gone through in the past the analysis of, what a rate buy down costs the builder versus, comparing that to an actual reduction in the overall price of the house. I mean, there's all the reason in the world for them to offer those kinds of incentives, especially when they own the mortgage marketing arm. And, I was talking with a brother that sells real estate primarily, and he was talking about how they've got ownership in some of the supply chain as well. And so for them, it's like, hey, if we don't make as much on the house, but we're still making something on the mortgage transaction and something on the supplies coming in to build the house, we'll give somewhere if it continues deal flow. And existing home sellers just don't, have those incentives that the builders do. And so I'm seeing it play out, exactly as you've observed as well.
It's interesting. It's nice to see these mortgage applications ticking up and people beginning to move around again and do some things. I'm fascinated to watch the housing market respond to lower rates and what happens with prices generally, what happens with buyer sentiment, and also so we'll watch that closely, Jeff. Those financing that, Fannie and Freddie, and ultimately, there's been a lot of talk about mergers. We've got the stock price sitting here at 13.89 for Fannie, and man, that's a lot. Where were we at? $2 a share, 150 or so, maybe when we started covering this. It's hot, and it's hot on the most recent chatter of a merger with Fannie and Freddie while also exiting conservatorship. What do you know?
Well, I know that I'm never smart enough to follow my own advice when it turns out to be good advice. I didn't buy Fannie or Freddie at $2 when I should have. So that part frustrates me, even though that's been kind of the market moves trade. Unofficially, we don't follow any other trades I offer, because the next one that I actually take action on will go the opposite direction. It's almost a certain thing. But, we have touched on this in the past, and I think there, anytime they're in the headlines and there's optimism around, some sort of exit of conservatorship, we've seen a steady upward trend in their pricing. In fact, I think that was one of our predictions that we made mid-year as to where the Fannie stock price would be. So it'll be fun to revisit that. But that said, Trump has floated this idea of the merger. We did have the Mortgage Bankers Association president come out and say, hey, that may not be the best thing. In fact, I've got a quote here that we can read on that, Mark. He's quoted as saying, competition between Fannie and Freddie has been central to their success in providing liquidity and stability to the mortgage market. Creating a government-conferred monopoly would diminish innovation, degrade service to the market participants, and heighten systemic risk by concentrating housing finance operations within a single entity. Just from that quote, a lot of that speaks to me. I mean, it makes a lot of sense that those two competing for services is better than their combination, and it does escalate risk. I mean, they're in conservatorship and have been for so long because of the risk of them failing in the first place. The government took them over and the taxpayer backstopped them. Combining them to a single entity that doesn't have a real competitor seems like a step in the wrong direction to me, would be my summary of it.
Yeah, I don't understand the plan nearly enough. I don't know if there would be some plan for them to operate these two divisions in loan lines. I don't know how that would go. So could competition remain? I mean, maybe, but yeah, my sentiment, I think, yeah, Dr. Mark Calabria, Ed Pinto were on talking about, increased competition being a very good thing for each of these, and having more options than the two that are there. And have them not have as much power, I think, is part of what they were wanting to accomplish with the suggestion of more competition. It makes sense. I think I'd need to see a plan. It's not often that I see this administration, from my perspective, I think a lot of people disagree, but put out something that isn't thought through one way or another. I've not seen the thinking, and I would be interested to understand the thinking. Because I imagine there is some logic behind what they're suggesting. Don't know what it is yet, so I'm sort of watching with bated breath, because I do think it's a really important initiative. The market seems to like it, and maybe it's just one step closer to exiting conservatorship that has everybody excited. But I think if they didn't like this merger concept, I'm not sure that the stock price would be up to the degree it is.
Yeah, that is an independent vote, in favor of at least the talking point is the stock price, reflecting that. I'm with you. I'm certainly maintain an open mind as to if there is a compelling plan that would work in a combination of those two. But on its face, it seems like going from 2 to 1 escalates risk and de-emphasizes competition and innovation, where going from 2 to 4, 5, or 6, would have the opposite effect. One of the other parts in the quote that the MBA president had, he did kind of temper some of that by saying, we do think there is some benefit to maintaining some level of consistency, from the appraisal process to the data standards and data ingestion. So he's saying, hey, we don't think combining them is the right thing to do, but there are some guardrails that really do help facilitate mortgage transactions. And Fannie and Freddie have collaborated on appraisal forms and formatting and reporting and that sort of thing in the past. I think he's saying, hey, don't throw the baby out with the bathwater. We do need some level of collaboration taking place, but combining them, he's arguing against. And absent a very compelling reason to do so, I find myself on that side of the equation at this moment as well.
Yeah, that sounds great, Jeff. Well, I am checking in for a flight to Atlanta for the Industry Advisory Council meetings tomorrow. So one of the reasons why we're recording a little earlier than normal here. You had a really interesting presentation that you gave to a bunch of real estate professionals, and I thought it was really interesting what you put together and how you put it together using the language models. Thought the audience might appreciate it.
Really interesting is a significant overstatement, Mark. I don't think most people would be, all that interested in what this was, but it's not uncommon. We talked last week with Keisha from NAR about appraiser and agent communication and interaction. It's not that uncommon, for us to get a request or an invite to come and talk to a sales office or a sales team around what we're seeing on the appraisal side. There are always questions around how do appraisers do what they do, why do they do what they do, and that sort of thing. So I was invited earlier this week to come and speak to a local brokerage around specifically FHA and VA property requirements, things that can become issues on the appraisal that agents just want to be able to be out in front of. And so as life goes for us that are juggling a bunch of things, I didn't have as much time to prepare for that as I wanted to. So I had kind of a fun melding of artificial intelligence, productivity tools in the real estate space. I'll share for just a second. I put a request into chat, use chat on this one. I've been playing with Grok and with Gemini and chat, and there are others I want to get more familiar with as well. But in prompting chat specifically on this one, I said, hey, here's what I'm trying to do. I'm looking for a one pager type of presentation, but I was really worried about it hallucinating or lying or not citing sources authoritatively. So part of the prompt was take as much time as you need to cite the sources and make sure that this is accurate and correct information. But asked it to produce a slide that I could take, hand out, talk about some of the common issues, both with FHA property and VA property requirements, and led to a great discussion. We talked for over an hour, about this topic and others that kind of naturally come up when an appraiser's in a room with a bunch of agents. I wasn't stoned or mocked or ridiculed too terribly, bad. But it was fun to see the real lift. I mean, I could have generated something like this, that I'm sharing here generally, and I did tweak a few minor things. I think that's one of the lessons with AI is it can really help get you, 70, 80, 90% down the road, but you really have to analyze it and make sure that what it's saying or producing makes sense and maybe is cross-checked or that sort of a thing. In a couple of weeks, you're going to the Industry Advisory Council. I'll be at the Appraisal Summit in a couple of weeks and doing a bit of a presentation with a collaborator, Jeff Whaley from Colorado, on best practices in utilizing artificial intelligence in appraisal space and that sort of thing. So it's been on my mind anyway, but it's kind of fun to go have the conversation and help me produce something that looked good and was useful in far less time than what it would have taken me to produce on my own. So it was good experience and just, one of many that, we're having trying to utilize artificial intelligence in the real estate space.
My read is that ChatGPT is uniquely capable of producing a slide like this compared to the other language models. Is that your perspective?
Yeah. So what I found is you can ask for the specific output that you want. In fact, I was prompting it just before we jumped on here to try to give me a chart around mortgage applications for refis and purchase transactions and that sort of thing. You can specify the desired output, like the file format that you want. This one happened to be a PowerPoint, a Microsoft PowerPoint. But it asked if I wanted it in an image or a PDF file. You can ask it to give you Excel files or, lots of different file format outputs and not just text. And so it's been, it was the nice thing with the PowerPoint in this case is it allowed me to easily make a few minor edits and tweaks, including being able to plug the podcast by putting in a link to our podcast on the document there. But it's not just a static, image, a JPEG image or something. So the file output, options and variability really does, utilize or kind of enhance the utility of the output that it gives you.
Very good. Well, it's cool to see. I think seeing these, how someone's using it in their everyday, this is the effectiveness that these language models are bringing to folks right here. So I think it's a great example for folks to see. And Jeff, it'll do it for me. I've got to close up shop here and get on the road. I am sure that the next 48 hours for me are going to be neck deep in UAD 3.6. So let's see how far we get there.
Well, Godspeed, Mark. I know it's a real workout. Just because I have it, we can close with our image that we quickly created, also using AI, if I remember correctly. Yes, you will be neck deep in it. You can query people whether they're ready for it or not, like our just for fun image is suggesting.
Yeah, this was a month or so ago, and people saying generally that they're ready, and none of the software providers are ready. Fannie and Freddie aren't ready in terms of approving the software providers on the appraisal side. We got time, but I'm not sure anybody's ready yet. So we're getting there soon.
Absolutely. Well, safe travels. Look forward to connecting next time.
Take care, Jeff.